The line forms before dawn, not because anyone announced there was a problem, because someone's neighbor mentioned something at dinner, and that was enough. That is how it always starts. Not with a headline, not with an official statement, with a whisper that travels faster than any newspaper ever could. And within hours of that whisper, the entire architecture of modern financial life begins to buckle in ways that most people never anticipate, because they have never lived through it, and because the history books tend to skip the part about what it actually felt like on the ground, hour by hour, in the first 7 days. So let's not skip that part. Day one is deceptively quiet for most people. The bank hasn't technically frozen yet. The ATMs are still dispensing cash, at least some of them. But the people who are paying attention, and the ones who heard the whisper, they are already moving. They are withdrawing, not dramatically, just quietly, steadily. And that act, multiplied across thousands of people doing it simultaneously, is itself the mechanism of collapse. This is what economists call a bank run, but that phrase makes it sound athletic, fast, obvious. In reality, the first day of a bank run looks almost normal. Argentina in December 2001 looked almost normal on day one. Cyprus in March 2013 looked almost normal on day one. Greece in the summer of 2015 looked almost normal until it didn't. What is actually happening beneath the surface on day one is a liquidity crisis in real time. Banks do not keep enough cash on hand to pay every depositor at once. They never have. That is the entire premise of fractional reserve banking. The system that has powered economic growth for centuries and also, in moments of panic, becomes its own undoing. The moment more people want their money back than the bank has available, the bank has a problem. And on day one, the bank is quietly, desperately trying to solve that problem without anyone noticing. Day two is when the ATMs start failing. Not all of them, not everywhere, but enough. You go to the machine, you put in your card, and it tells you it cannot process your request, or it gives you less than you asked for, or it simply has no cash left and no one has refilled it. This is the moment that converts rumor into reality for ordinary people. Because an ATM that doesn't work is not abstract. It is standing in front of you. It is your money, or what you thought was your money, suddenly inaccessible. In Cyprus, the people arrived at ATMs on a Saturday morning in March 2013 and found them empty or limited. The government had announced a bank holiday. The weekend had become a wall. Day three is when the government speaks. And here is the thing about government statements during a banking freeze. They are always designed to calm, and they almost always do the opposite. Because the statement itself confirms that something is wrong. Officials use words like temporary and controlled and stabilizing. And every person listening hears those words and thinks about what the opposite of those words means. The statement in Cyprus said the banks would reopen in a few days. They did not reopen for nearly 2 weeks. In the United States during the banking panics of the early 1930s, statement after statement promised stability while bank after bank quietly shuttered. Words from officials in a crisis carry a specific kind of weight, the weight of things that are not being said. By day four, the cash economy has already begun. This is one of the most underappreciated dynamics of a banking freeze, the speed with which people revert. Businesses that normally operate on credit terms start demanding payment up front. Landlords who accepted checks start asking for physical currency. The corner store that ran a tab for regular customers closes the tab. The informal economy, the one that runs on handshakes and trust and delayed payment, seizes up almost immediately, because trust is precisely what has been broken. In Greece during the capital controls of 2015, businesses began stockpiling euro notes. Suppliers started refusing to deliver without cash in hand. The formal economy and the shadow economy started trading places in terms of which one actually worked. Day 5 is when people start realizing what they cannot buy. Not because goods have disappeared, not yet, but because the mechanism for purchasing them has been disrupted. Credit card processing sometimes fails when banking infrastructure is unstable. Online transfers get delayed or blocked. Businesses that cannot pay their own suppliers start running low on inventory. The shelves are still full, mostly, but there is a new anxiety around them. People begin buying more than they need, not out of greed, but out of a rational calculation that tomorrow might be worse than today. That calculation, again multiplied across thousands of people, turns a potential shortage into an actual one. This is how a financial crisis becomes a supply crisis, not through some separate catastrophic event, but through the logic of human behavior responding to uncertainty. Day 6 is when the political dimension explodes. Protests, anger, the specific kind of fury that comes from feeling that something was done to you, not by nature or accident, but by decisions made by people in rooms you were never invited into. In Argentina in 2001, the government froze bank accounts as part of a policy called the corralito, which literally means little fence. People stood outside banks and banged pots and pans. They gathered in the streets. Within days, the government fell. Not one government, multiple governments, in rapid succession, because the political cost of what had happened was too enormous for any single administration to absorb. The banking freeze had become a legitimacy crisis, which is a different kind of problem entirely, and one that takes much longer to resolve. Day 7 is when the new rules arrive. Capital controls, withdrawal limits, restrictions on international transfers. The government, having failed to prevent the panic, now attempts to manage its consequences through regulation. In Cyprus, when the banks finally reopened, depositors found that they could only withdraw a small amount per day. Large deposits above a certain threshold had been partially confiscated, converted into bank equity, in what was called a bail-in. People who thought they had savings discovered they had, in effect, involuntary investments in a failing institution. In Iceland in 2008, capital controls were imposed that lasted, in various forms, for nearly a decade. The week that began with a rumour ended with a fundamentally different set of rules about what money could do and where it could go. And here is what the history books tend to leave out about those 7 days. The people who were hurt worst were almost never the people who caused the problem. The wealthy, the connected, the ones who had access to information early, they moved first. They got their money out, or moved it offshore, or converted it into something the freeze couldn't touch: real estate, foreign currency, gold, assets that exist outside the banking system. The people who waited, who trusted the institutions, who believed the official statements, they were the ones standing in line on day 7, and being told that the rules had changed. This pattern is not a coincidence. It is not the result of malice in every case, though sometimes it is. It is the result of information asymmetry, the oldest dynamic in financial history. The people who know more act faster. The people who act faster preserve more. And the people who preserve more are rarely the ones who needed protection the most. What is remarkable, looking across these events, is how consistent the timeline is. Argentina 2001, Cyprus 2013, Greece 2015, Iceland 2008, the United States in the 1930s, when nearly 9,000 banks failed over the course of a few years. The details differ, the currencies differ, the political contexts differ enormously. But the sequence, the whisper, the quiet withdrawal, the ATM failure, the official statement, the cash economy, as the supply disruption, the political explosion, the new rules, that sequence repeats with an almost mechanical consistency. Because it is not driven by the specifics of any one country's banking system. It is driven by human psychology, by the logic of panic, by the mathematics of fractional reserve banking meeting the reality of mass fear. There is a reason that every major civilization that has ever built a banking system has also, at some point, watched that system seize. It is not because bankers are uniquely corrupt, though some have been. It is not because governments are uniquely incompetent, though some have been. It is because the system itself, the elegant, productive, growth-enabling system of lending out deposited money and trusting that everyone won't want it back at once, contains within it the seed of its own periodic failure. The trust that makes it work is also the vulnerability that makes it fragile. The people who understood this, who had lived through a freeze or studied one closely enough to take it seriously. They tended to behave differently before the crisis arrived. Not because they were pessimists, not because they distrusted capitalism or modernity, but because they had internalized a specific historical lesson. Institutions that appear permanent are often just stable. And stability, as anyone who has watched a line form before dawn at a bank that opened just fine the morning before, is not the same thing as permanence. The line always forms before the announcement. The announcement always comes after the damage is already done. And the 7 days that follow are not an anomaly in financial history. They are the recurring chapter that every generation encounters, and every generation somehow manages to be surprised by. Because the previous generation's crisis feels like history. And history, until it doesn't, always feels like something that happened to other people.